Forecast, a huge move ahead in crypto, the data nobody's talking about. Something massive is brewing in the crypto markets right now, and if you've been paying attention to the data, you can already feel it. The charts, the flows, and even the macro indicators are aligning for what could be one of the biggest directional moves we've seen in months. We're not guessing here. We're tracking real signals, ETF inflows, derivatives positioning, stablecoin liquidity, and on-chain accumulation, the exact metrics that institutional traders use before a market explosion. In this video, we'll break down, step by step, how to forecast a huge move ahead in crypto. No hype, just data, patterns, and real on-chain evidence. If you trade, invest, or simply want to know what's next, stay tuned till the end.
From this day on, America will follow the rule that every Bitcoin knows very well: never sell your Bitcoin.
Macro backdrop, the trigger. Every major crypto rally starts long before the charts show it. It starts in macro liquidity, when central banks open the taps. When the Federal Reserve hints at rate cuts or policy easing, risk appetite returns, and capital begins to rotate from cash and bonds into high-volatility assets. That same shift drove the 2020 rally and partially sparked the 2023 rebound. To forecast the next big move, watch the Fed funds futures, the CPI and PCE reports, and most importantly, the US dollar index. A weakening dollar fuels crypto rallies. A strengthening one tends to cap them. Before checking Bitcoin's chart, check the Fed's calendar. That's where every crypto move truly begins. Institutional flows, the new money. Retail excitement creates price spikes, but institutional inflows create trends. Since the approval of spot Bitcoin ETFs, we've seen the largest wave of institutional accumulation in crypto history. When ETF inflows stay positive for several days in a row, Bitcoin's price almost always reacts. You can track these flows from BlackRock, Fidelity, and Grayscale on public dashboards updated every day. Sustained inflows mean real demand. Flat or negative days signal potential slowdowns. Institutions aren't buying memes. They're buying Bitcoin in billion-dollar chunks, and those purchases are visible if you know where to look. Stablecoin liquidity, the fuel. No liquidity, no rally. Stablecoins are the oxygen of this market. When stablecoin supply increases, it means new capital is entering the system. Capital that can be deployed instantly into crypto. Watch the total market cap of USDT, USDC, and DAI. Rising supply means buyers are loading up. Shrinking supply means money is exiting. Forget emotions and headlines. Stablecoin charts reveal where the real firepower is sitting. Derivatives positioning, the leverage meter. Here's where volatility begins, the derivatives markets. Futures and options show us how leveraged traders are positioned. When open interest rises and funding rates turn positive, it means the market is crowded with longs, setting up for possible liquidations. When funding goes negative and open interest builds, it signals short pressure, which can lead to explosive short squeezes. Options data adds another layer. When large call positions cluster near key strikes, market makers hedge by buying spot, creating upward momentum. Before the next big breakout, you'll see it in the derivatives data, not the news. On-chain signals, the smart money trail. If you want to follow the smart money, on-chain data is the purest signal you can find. Look at exchange inflows and outflows. Large outflows mean accumulation. Large inflows often mean distribution. Track whale wallet clusters, long-term holder SOPR, and MVRV ratios. When these indicators rise together, they tell you that long-term players are accumulating, not speculating. You don't need insider information. The blockchain itself shows you when big money is making its move. Technical structure, the breakout zones. Markets don't move randomly. They explode when liquidity gaps are breached. Identify the volume profile voids, zones where little historical trading occurred. When price enters those gaps, it often travels fast until it finds the next liquidity cluster. Range breakouts, high time frame resistances, and liquidation zones. That's where the next big candle begins. Professional traders don't predict direction, they position before volatility. structural catalysts, the timers. Every major crypto cycle has its spark, the event that ignites the next phase. Bitcoin's halving in April 2024 cut miner rewards in half, tightening supply through 2025. Pair that with regulatory clarity, new ETF approvals, and growing adoption, and you have the framework for a supply squeeze. Less supply, same or greater demand. The result is inevitable: price acceleration. Risk factors, the double edge. But remember, the same fuel that drives rallies can also power crashes. High leverage creates liquidation cascades. ETF outflows can reverse bullish trends overnight, and regulatory shocks can drain liquidity in hours. Firm tone. Data should guide your conviction, not emotions. A huge move ahead doesn't always mean up. Sometimes it's straight down. The checklist, forecasting the move. Here's your professional forecast checklist. Fed easing signs and soft CPI prints. Positive ETF inflows sustained for several days. Expanding stablecoin market cap. Rising derivatives open interest with skew. Exchange outflows and whale accumulation. Breakout from key technical range. If 4 or more of these flash green simultaneously, get ready. Volatility is coming. Finally, the next huge crypto move won't be triggered by hype. It'll be powered by numbers. If this breakdown helped you see the market more clearly, subscribe, drop a comment with the token you're watching, and I'll track its data in the next update. Stay data-driven, stay early, and always stay liquid.